Welcome to the Stupid Agent Man podcast, a production of StupidAgentMan.com. We're asking the stupid questions of the life, annuity, and long-term care business so you don't have to. This podcast episode is brought to you by NoProspecting.biz, where no prospecting means more time for business. Visit them on the web today at NoProspecting.biz. That's NoProspecting.biz.
Okay, thanks for joining us for the Stupid Agent Man podcast. This is officially episode 2, and our guest today is Ken Weinbrenner. Ken is Regional Marketing Director for Lincoln Financial, and thanks for joining us, Ken.
My pleasure. I guess I'm the second oldest stupid agent then. Is that the case? Is that why I got to go second? Whoever had it first was the number one agent?
There you go. Well, I'm the Stupid Agent Man as your host, so you're the one that's going to provide the smart answers. I do want to plug you real quick, Ken. I want to brag on you because you've been working with us for many years now, and I want to just say to all the marketing organizations out there, anybody else that's looking for a speaker, I mean, Ken is one of the best speakers for a group of agents, of producers that I've ever seen. And I mean, we've seen some good ones, seen plenty of bad ones, that's for sure. But just you have a way of just capturing the attention of the agent and speaking in terms of the producer. Pardon the pun term, but
appreciate those kind words. I came up through the field, so I understand it. And to be very frank, I try to look at things from what is the client trying to get accomplished, and what's the best deal for the client. And if the agent's looking at it from that perspective, we get along extremely well in those situations.
And one of your past performances and topics is our topic for today. And the stupid question of this episode is, what in the heck is permanent term insurance? And even I, as the host and Stupid Agent Man of this episode, I'm even a little bit ashamed to ask that question because permanent term is kind of an oxymoron in itself. I mean, permanent insurance being whole life, universal life, and then term insurance, typically 10, 15, 20, even 30-year term or period for that coverage. But permanent term insurance, what in the heck is that, Ken?
Okay. Permanent term insurance. Let's just back up a step, and then we'll get right to that question. As you were saying in your opening comments, the term insurance marketplace has normally been defined as way back when you had 1-year term. I don't know of anybody who still writes 1-year term. Then it went 1 year and 5 year, and I don't know about not many companies write 5-year anymore. But then it went 10, 20, 15, sometimes out to 30 or even 40-year term insurance. And it's for the person who says, look, I need to buy some insurance, and I only want it to go for a specific period of time. I don't want it to necessarily be there when I die. If I die in the next 20 years, I want it to be there because I want it to take care of the mortgage on my house, or I want to take care of getting my kids educated, or I want to take care of leaving something behind for my wife if something happens before I get to my retirement or something like that. So that was the reason for term insurance. Well, then along came universal life insurance, and it was a great product. But one of the downsides to traditional universal life insurance is, yes, it does build cash, but if you get caught in a low interest environment like we find ourselves today, all of a sudden those policies started to lapse. And so the industry, in response to that, came out with what's called permanent term or guaranteed death benefit universal life insurance. And what defines guaranteed death benefit universal life insurance in today's insurance market, because it has evolved over a period of time, is basically it is life insurance that builds no cash value. That's hence the reason for defining it as permanent term. There is no cash value in the contract. And the idea is that the client can say to us, I want this coverage to go from, say, 60 to 85, and that's all the further I want it to go. And he can do that, or he can say, no, I want it to go from 60 to 92. He can have it go that length. If he says, I want it to go from 60 to 126, he can have it go that time. But regardless of what he does, however he structures the policy, it will not build any cash, but it is absolutely guaranteed. And at Lincoln, for example, all of our policies, everything in those contracts are contractually guaranteed. There's no current and guaranteed numbers. There are only guaranteed numbers. In fact, when you get the illustration, you only get one set of columns. Here's the premium. Here's the face amount. There's zero cash value, and here's how long it's going to last. Now, the advantage that permanent term does have, and I've actually experienced this, is you may have a client who says, I only want this to go to age 90. For example, and he gets it out to age 90, and lo and behold, the client finds themselves in a situation where death is going to be imminent, but the policy is about to lapse at age 90. Unlike traditional term insurance, where you don't really have a lot of choices, with permanent term, you can literally go to your insurance company, in this case Lincoln, and say, Lincoln, how much would I have to give you to keep this policy in force 1 more year or 2 more years? Because what you really want to do is you want to make sure that you've collected on that death benefit. And the answer is the insurance company runs a calculation. They send you the note and said, here's what the premium is, and it's guaranteed, and it will make sure that the client will, in fact, collect on the death proceeds. I just will give you a quick story. I was speaking to a group of CPAs on the topic of guaranteed death benefit or permanent term life insurance. And I got back to my office, and I got a call from one of the CPAs that I was talking to, and he said, hey, my client is literally at death's doorstep. He's got this product that's going to expire in the next 30 days, and he's going to live longer than that, but is there any way I could roll this over into your guaranteed death benefit? He got the guarantee part right, or the permanent term. What I said was he obviously didn't understand the underwriting part of the process. So I said to him, no, but what you can do is you can take the policy down to the client's neighborhood bank and borrow the money and pay the premiums, and that's exactly what they ended up doing in that given situation. And the client, unfortunately, passed away about 6 months later, but the family is now walking around with about $750,000, almost $800,000 that would have just fallen off the board because they didn't know how to make it work. And all I'm saying to you is that's what permanent term has the ability to do for you. It has the ability to say, okay, fine, I can pay it to a certain period of time, and if I've guessed wrong and I live longer than I think I'm going to live, and I want to keep it in force, I can continue to keep it in force, and I can tell you today what that number would be, and it won't change if I told you the number today or if you waited for 30 years to get out there and then ask. The answer to the question is going to be the same answer, because everything in those permanent term or guaranteed death benefit universal life products, those numbers don't change.
Well, correct me if I'm wrong, Ken, but the traditional term insurance, say a 20-year policy, yes. Somebody buys that, and the idea is, hey, you're saving for retirement. You're going to have a bigger nest egg 20 years down the road. You're not going to have the debt. Your house is supposed to be paid off, and all of this.
Right.
And so therefore, when it expires, you will not need it. Now, in the real world, in fact, I remember my father, getting to mid-late 60s, and he had term policies expiring, and he wanted that insurance. He was needing it for other things,
right.
And whether it's grandkids or whatever. So in the real world, it's not as simple as that 20-year term expires.
No, and the idea is, and one of the other advantages of permanent term is I can pay it to say, okay, fine, I want to pay a lower premium now because I'm a younger person and I, to be very blunt, don't have the cash flow. So I want to go from, say, 40 to 65. But at 65, let's say I bought, and I'm just picking a number out of the air, I want to buy $1 million of insurance. But when I get to be 65, what I really want to know is, what would I have to continue to pay to keep $500,000 of that in force until the day I die? And you can literally structure these permanent term policies so that you have a certain face amount for a period of time, then the face amount drops, and you can continue to pay the same premium you've been paying, but for less insurance, but it's now guaranteed to go forever at that lower number. So you, in effect, solve the problems of mortgages and kids' education. And then once all of that had occurred, you've now left a legacy behind for your family, whether it be your spouse, your kids, your church, or whoever you've left the money behind for, but you're also in a position of leaving a legacy, and you've done your investing, your accumulation of wealth outside of your life insurance policy. But the death benefit is guaranteed to go for however long you want it to stay in force.
Well, I think you just answered my next question, but I'll ask it anyway, just to make it crystal clear for the producer out there. Take a producer that's about to present this concept, and they're just selling against somebody about to pull the trigger on a very affordable term insurance policy from XYZ company, and you want to present, or they want to pitch this permanent term concept. What's your kitchen table pitch, so to speak, to get them interested in this permanent term? Can you walk us through that?
Yeah, sure. And I want you to understand, one of the things that Lincoln has just done is on our regular term side is we've now gone to the point where we will issue regular term insurance all the way out to age 80, which means that we'll issue a 10-year term, which would mean we'd get the client to age 90. Now, that's the good news. The bad news is if the client is healthy enough to qualify at age 80 for the insurance, they probably are going to live longer than that 10-year period of time. Because, it's an old joke of the industry, but anybody who's buying traditional term insurance, in effect, you're betting that you're going to die, and the insurance company's betting that you're going to live. Because the premiums are so much lower, and it's kind of like they say they don't build those big buildings in Las Vegas with people's winnings, they build it with their losings. Well, in the insurance business, when you buy term insurance, the vast majority of term insurance that's sold in the country today, whether it be at Lincoln or anywhere else, the vast majority of traditional term insurance never results in a claim. So my question would be, if I were sitting at a kitchen table with the client, I would say, here's the scenario. You're 65 years old. You bought a 15-year term, so that's going to get us to age 80. Do you plan on being gone at age 80, or do you have no need for the insurance? What is the purpose of the insurance? Because one of the things I always try to get the client to focus on is, what's the purpose? Why are you buying this policy? In other words, he's not buying it so that I can pay for my kids' educations. Theoretically, he's buying it to pay for his kids' education or to cover his mortgage or whatever it is he's using the policy for. So I want to define, if what you have is a temporary need, then there's a good reason to buy, quote-unquote, temporary insurance. But if what you have is a permanent need, you're kidding yourself and your family and doing them a disservice by buying temporary coverage that's designed to solve a permanent need. The question is, do you want to collect on this policy when you die? That's really the bottom line question. So if I'm sitting at a kitchen table with somebody and I've got a 65-year-old and he's looking at a 20-year term, I know that his life expectancy is somewhere between 86 and 90 years old, and he just bought a policy that's going to lapse when he's 80. So my question is, if you are no better or no worse than normal or average, you're going to outlive this coverage. Is there any reason that you want to buy this coverage based on that? If that's the case, let's buy something that your family or your kids or whoever is going to collect on, and you can actually leave that legacy that you'd like to leave.
And last question, I hope somebody, presenting this idea, maybe selling against a friend agent of the clients at church or whatever, and they're telling them, well, this term policy, my friend said this term policy that I'm going to buy is convertible to permanent if I ever want to. How do you address that?
Okay, there's one question you have to be careful of when you buy term insurance, and I will tell you how it works at Lincoln, and then I will tell you how it works in the bulk of the industry. At Lincoln, you can convert your term insurance up to age 70 or the length of the term period. So, for example, if I sold a 45-year-old a 30-year term policy, he could convert that policy any time up until he was 70. So he'd have 25 of the 30 years he could convert. If I sold a 60-year-old a 10-year term policy, he could convert it any of those 10 years because he could convert it as long as the term period, which is 10 years, or age 70, which happens to be the end of the term period. So he could convert it any of that period of time. The good news at Lincoln is you can convert it to any permanent product that we write. Any product that we write that's permanent insurance, you can convert when we don't ask any health questions or anything else. You can just buy the policy and go from there. If you were preferred when you got the term, you're preferred when we get this. We don't ask any health questions. You could be very sick and we wouldn't have any way of knowing that. The problem is that with most carriers, you either have no conversion privilege, or if you have a conversion privilege, it is to a very specific product. And that product is normally a product that is not very competitive. It's not one of their traditional policies. It's a policy designed specifically for conversions, because they know that the only people who are going to convert their term insurance at that price is somebody who couldn't qualify for anything else. And so, to be very frank, they simply give you a product that's not very competitive, and they know that that you have to convert it. So they kind of have you up against between a rock and a hard place, and you got to convert the policy because you want the insurance, and it's unbelievably expensive. personal situation. My own son was involved in a scenario where he inherited a client. The guy is not eligible to collect, to be able to qualify for insurance. They wanted to do a conversion, and when they checked, the policy that he could convert to was more than 3 times the premium of what he could have bought if he'd have bought it from the exact same company, a similar kind of policy that was not a conversion policy. So you just have to be careful. If you buy term insurance, you want to know what kind of policies can convert to and at what price.
Good information to know. And back to the permanent term from Lincoln, what riders are available on that policy? Are they more attractive than your typical riders on term insurance?
Well, you have waiver of premium, which says if you get, you become disabled, we'll waive your premiums. And right now, that product, you could also have a kid's rider on there. You could also have a spouse's rider on there. Coming in May, we will have a long-term care type rider that will be added to that policy, but it will not be available until May.
Well, we can't wait for that. That's very interesting. And premiums, are they as flexible as conventional term? It sounds like it.
Yeah, it's actually more flexible than conventional term. For example, if I'm paying on my permanent term policy and I'm paying a premium and I happen to miss a year, the policy doesn't lapse. Where in a term insurance policy, if you don't make the premium payment, the policy goes away immediately. So in a permanent term policy, I may have a 20-year term, so I'm paying the premiums, and I get to the 6th year, and we have a really hard time that 6th year. In the 7th year, I got no place, I can't pay the premium. Nothing happens. The policy would stay in force, and then you could come back in the 7th or 8th year and pick up the old premium and stick in the new premium and keep the guarantees and everything going just as you had before, where you don't have that flexibility in term insurance. In term insurance, you either pay the premium or you lose the coverage.
Ken, you not only answered the stupid question of the episode, what is permanent term insurance, you gave us a lot of great information. Thanks for joining us as a guest on this podcast.
My pleasure, and good luck with your clients and good servicing. Take good care of them, and they'll take good care of you. Appreciate you. Thank you for our relationship. I appreciate you. Thank you, buddy.
All right. Bye-bye.
Bye-bye.